Understanding order blocks, a simple guide to smarter trading. Welcome. Today, we're diving into a concept that's crucial for making informed trading decisions: order blocks. Whether you're new to trading or looking to sharpen your skills, this guide will break down what order blocks are, why they matter, and how to use them effectively. Let's get started. What are order blocks? Imagine you're driving and see a traffic light turn red. That signal tells you to stop because others might be moving in a different direction. In trading, order blocks act like those traffic signals. There's specific zones on a price chart where big market players, like institutions, likely placed orders before a major price swing. These zones often become turning points where prices might reverse or pause. Here's how they work. In a bullish trend, look for the last downward bearish candle, right before prices shoot up sharply. This candle often clears out existing sell orders below it, creating momentum for the rally. In a bearish trend, focus on the last upward, bullish candle before prices drop suddenly. This candle typically sweeps by orders above it, fueling the sell-off. These zones matter because they show where large volumes of trades were executed, giving clues about where prices might react next. Why do order blocks matter? Think of order blocks as footprints left by big traders. When prices return to these zones, it's like retracing steps. There's often leftover interest buying or selling there. For example, if prices rallied after a bearish candle and cleared out sellers, that candle's zone might now act as support, a floor where buyers step in. If prices dropped after a bullish candle wiped out buyers, that candle's zone could become resistance, a ceiling where sellers take over. By spotting these zones early, you can anticipate potential reversals or continuations in the market. The psychology behind order blocks. To truly grasp their importance, let's explore why these zones form. 1. Market manipulation. Big players often trap retail traders by triggering stops, e.g., pushing prices briefly below support to shake out weak hands before reversing direction. 2. Liquidity pools. Order blocks often align with areas where liquidity clusters like buy or sell orders are stacked at key levels. Institutions target these zones to execute large trades efficiently. 3. Sentiment shifts. A strong reversal after an order block signals a shift in control from one group, e.g., sellers, to another, buyers. Example: imagine prices drop sharply but then reverse at an order block zone. This suggests sellers ran out of steam and buyers stepped in aggressively, a sign of hidden strength. How to spot valid order blocks. Not every candle is an order block. To confirm 3 key rules apply. 1. Liquidity sweep. The candle must clear out orders by breaking past the high/low of the previous candle. Example: in an uptrend, the last bearish candle should drop below the prior candle's low before reversing upward. 2. Imbalance gap. After the sweep, prices should leave a gap between candles, like jumping from one step to another without overlapping. This gap signals urgency among buyers/sellers. 3. One-time use. Once prices revisit an order block and react, e.g., bounce off support, that block loses its power. Focus on untested zones for future trades. Pro tip: always wait for prices to confirm the block strength, like waiting for a car to slow down at a stop sign before proceeding. Common mistakes traders make. Avoid these pitfalls when identifying order blocks. Overlooking imbalance. A valid block needs that gap. If candles overlap too much, it's just noise. Ignoring time frames. A block on the 15-minute chart might not matter on the hourly chart. Align your analysis with your trading style. Chasing mitigated zones. Revisiting old blocks increases risk. Stick to fresh zones. Real-life chart examples. Let's simplify with visuals. 1. Bullish example. Prices are falling steadily, indicating a bearish trend. A final red candle drops sharply, but then reverses into 3 strong green candles. The red candle's low becomes support if prices return here later and bounce. It's a valid order block. 2. Bearish example. Prices are rising, showing a bullish trend. A final green candle spikes up, but then crashes into 3 red candles. The green candle's high becomes resistance. If prices revisit this zone and stall, it's time to consider shorting. Watch out for false signals. If prices test an order block but don't leave an imbalance gap or get stuck sideways, it's likely invalid. Mitigation. If prices return multiple times without reacting strongly, move on. That block has lost its edge. Trading strategies using order blocks. Once you've identified a valid order block, here are 4 ways to enter trades safely. 1. Wick entry. Place your buy-sell order at the tip of the candle's wick, the thin line above/below the body. Pros. Higher chance of your order being triggered since prices often retest wicks. Cons. Requires wider stop-loss risk management, which reduces profit potential slightly. 2. Body entry. Target the middle of the candle's body, the thick part. Pros. Tighter stop-loss equals better reward-to-risk ratio. Cons. Prices might not reach this zone and could lead to missing opportunities. 3. Midpoint entry. Split the difference. Enter halfway between the wick and body of the order block. Pros. Balances safety and profit potential. Popular among experienced traders. 4. Aggressive entry. Place orders at the edge of the body, closest to recent price action. Pros. Maximizes profit if right. High risk if wrong. Use cautiously. Risk management tip. Always set stop losses just beyond the order block's edge to avoid getting caught in false moves. Combining order blocks with other tools. Boost your confidence by pairing order blocks with trend lines and channels. Confirm if the block aligns with broader trends. RSI or Mark D. Check for overbought or oversold conditions near blocks for confluence. Volume analysis. High volume at an order block equals stronger signal. Example. If prices bounce off an order block and RSI shows oversold conditions equals a double confirmation for a long trade. Advanced tips for seasoned traders. 1. Multiple time frame analysis. Validate blocks on higher time frames, e.g., daily charts, for stronger signals. 2. Order block chains. Look for clusters of blocks forming support/resistance zones like stack floors in a building. 3. Market context matters. In choppy markets, blocks lose reliability. Save them for strong, trending conditions. Final takeaways and next steps. 1. Practice patience. Wait for all criteria, liquidity sweep, imbalance, and untested before jumping in. 2. Start small. Test strategies on demo accounts. First, build confidence without risking capital. 3. Stay disciplined. Not every setup works. Cut losses quickly when blocks fail. Remember, trading isn't about predicting every move, it's about preparing for high-probability scenarios. By mastering order blocks, you align your strategy with what big players are doing, and that's how you trade smarter. Ready to apply this? Here's your challenge. 1. Open your trading platform and find 3 historical reversals/breakouts. Mark potential order blocks using today's rules. 2. Note if they met all criteria, liquidity sweep, imbalance. Did price respect them later? Share your findings in comments below. Let's learn together. Thanks for joining this deep dive into order blocks. If you found this helpful, smash that subscribe button and turn on notifications so you never miss our next video. Got questions or topic requests? Drop them below. Happy trading and see you next time.